Hello and welcome back to the fifth learning module in corporate issuers. My name is Darren Lee. We'll continue our study of this section here with capital investments and capital allocation. Now, in the previous learning module, we dealt with short-term investments and financing activities. So now we are going to make the shift to long-term investments and financing activities. There are four key takeaways from this module that you'll need to understand well in order to be prepared for the exam. So I'm going to start off with the first one. The one on capital investments. This is primarily qualitative in nature and looks at various types of capital investments and their purposes. Then we're going to do a bit of a switch and we're going to go into a more quantitative section which expands on the first one and look at three quantitative tools to perform the analyses. At the same time, we need to recognize the capital allocation process is not perfect. So what we need to understand from a qualitative perspective here is what these common pitfalls are, and those will be discussed. Now, last point here with real options. Now, even though the objectives of both capital allocation and estimating expected investment returns, they're to choose the optimal investment amongst the available choices. However, one little subtlety we need to recognize is that a firm's decision today could impact future investment decisions. So that's where real options come in. And those are considered largely in a quantitative manner. So this reading here, this section, is probably one of the more technically challenging sections because of the quantitative, but the overall reading here is nicely balanced with both quantitative and qualitative aspects. The most fundamental point about capital investments is the minimum lifespan of 1 year. Okay, so 1 year is sort of the borderline mark which defines your long term. And of course, this supports the use of discounting when evaluating projects using net present value, for instance. Now, in taking a more intuitive approach, we have chosen to first examine how capital investments are recorded on the three main financial statements. So this will sort of also be covered in the financial statement analysis section as well. So this will be a little bit of a review, right, of concepts such as on the balance sheet, these assets would be recorded at net book value. And then on the income statement, we would look at depreciation or amortization expense, right? And then on the cash flow statement, we would only look at cash items, so therefore the depreciation or amortization expense is ignored, and we only look at cash outlays, let's say, for the project, or inflows as well if we are selling projects or assets for proceeds. We're going to work through the four main types of projects, and I'm going to start off here with the going concern project. Okay, this is of course very common in practice, since companies will need to maintain or replace their capital assets periodically. Investments are needed to continue the company's current operations and maintain the existing size of the business. So this is a cost of doing business. Now, common going concern projects include replacing assets near the end of their useful life, maintaining IT hardware and software, and then continuous improvements to existing facilities here. So we'll start and kind of say here that maintenance and capital expenditure, these types of projects in general are considered low risk. And they're relatively straightforward to evaluate since they mirror the existing business operations. So that's where the low risk comes in because, we're not doing anything particularly new here. We're sort of continuing with what we've already done. Now, if we go a little further, if there's a project that strives to improve efficiency, then this would become an example of what we have in this first bullet point of a cost-benefit analysis. And this is between the upfront cost versus the present value of the annual savings. That is demonstrating net present value, like a textbook example of that. Okay. In the second bullet point, we get into match funding, and that's demonstrated, let's say, by a company issuing a 10-year bond to finance the replacement of equipment that has also a useful life of 10 years. So in other words, the financing term is neither too short nor too long compared to the useful life of the asset. Now, the second one, project gets us into regulatory compliance, okay? This usually is the type that management doesn't care too much about. They tend to want to avoid these because they don't really have any benefit, right? However, in real life, they cannot avoid these or else they risk being non-compliant with new rules and regulations, and as a result they could be subject to potentially costly fines or, worse yet, the inability to continue business operations. So that's the sort of the whole point, right? I'm saying here there's no corresponding revenues, right? But I would argue that the avoidance of penalties could be seen as a form of indirect benefit, right? By avoiding a cash outflow that you might incur in the form of penalties here. Anyways, the thing to remember here is that with increased regulations, then the companies must do a reevaluation. Whether the returns on an underlying business remain attractive once these additional costs are factored in. Now, you do the analysis, it may be that the company determines that the business is no longer meeting the minimum return requirement once the additional regulatory costs are considered. So as a result, in that case, the optimal decision may be to wind down or reduce business operations or completely discontinue it, right? So on this slide, we also here just sort of talk about, some of the potential opportunities of these projects and some benefits here. All right. Now, just to sort of give an example of regulatory compliance project, with the Danske Bank in Denmark, this is a good example of what I say, short-term pain for long-term gain, right? So there's a short-term, there should be a short-term cost involved here. What I'm saying, in other words, is that I think if you read all this, it would have been a better idea for Danske Bank to think about the long term by spending the money up front on building a more solid internal control system to avoid the much more significant monetary fines and reputational damage that occurred as a result of the insufficient internal controls. Okay, so that's really what it boiled down to. I mean, this is not a sexy or attractive type of thing that management wants to deal with. So sometimes they just try to avoid it, and unfortunately, in this case, it was too late. Businesses seeking to grow often engage in capital projects to increase the scale of existing business activities, expand their scope to new areas of operations, or enter new areas. So this is usually the more attractive and desirable type of project because if a company expands and does well, probably management compensation is going to increase as well. At the same time, these expansion projects usually involve more uncertainty, time, and capital compared to going concern or regulatory compliance projects. So I think the key word here is risk. Okay, so let's break this down a little bit here. The risks with expansion projects are usually execution risks and most likely experienced by startup companies, ones that don't have the track record or the experience to deal with these types of projects. Now, at the same time, established companies often spend a lot on expansion projects to speed up product development cycles, maintain competitiveness, acquire more customers, and just to maintain an edge over their competitors. So capital investments are often required if an established company chooses to extend its existing operations to adjacent products and services or expand to new regions or markets. Now, in this slide involving a very established company, Sony, there's the expansion of business scope to take advantage of existing capabilities to meet the needs of a new and different customer base. Okay, so that is noted here in this very last section that you want to focus on. The last part of the description, it says it will further SIE's vision to reach billions of players. Okay, and that's sort of a very good example or illustration of that. New lines of business projects gets us into another category, often a very unique situation that provide unusual growth, investment, or innovation opportunities for a company. Now, obviously, such projects are the riskiest type of capital investment. This brief example of expanding into a new line of business is similar to the previous example of Sony involving the expansion of business scope to take advantage of existing capabilities to meet the needs of a larger customer base through an offering of a wider range of products. And that's exactly what they're doing here. So they're saying, well, we have, even though the line of business is completely different, right? I mean, they're dealing here with drinks versus cosmetics and dietary supplements. The underlying skills are transferable into a different industry here. Now, the objective of capital allocation, of course, if we just sort of step back here, is to earn risk-adjusted returns that are greater than what investors could earn on similarly risky investments elsewhere. So with capital allocation, we will briefly elaborate on the 4 steps, but steps 2 and 3 are the most important that you need to focus on for exam purposes. Okay, so step 1 is idea generation, and this is often generated internally by management, although external consultants could be engaged for advice. Ideas must be considered in context of competitive environment and the company's current operations and capabilities. right? It's always contextual here. I mean, the greatest ideas have to always be in context of where they are currently at and what is feasible. Step 2 is the investment analysis, and we're going to forecast the timing, the amount, the length, and the volatility of cash flows. That's going to come up a lot in our NPV, IRR, and ROIC analysis here. Step 3 is planning and prioritization. So we're going to select projects as a group, not necessarily in isolation, that provide the most value added on a risk-adjusted basis. Okay, and the key thing here is it has to be a risk-adjusted basis. So not necessarily the highest absolute return, but taking into account the relative risk. So this, of course, has to be, as a rule here, the investor's required return, so greater than that. Step 4 is the monitoring and post-investment review. This is what is commonly known as budget to actual comparison, and then adjusting investment levels accordingly. This is, of course, sometimes I call it a post-mortem here, useful for determining systematic errors in capital allocation, also to help in enforcing operating discipline and generating future investment ideas. The use of net present value, this is by far the most common metric, assumes that there is specific project information provided by management for the analyst to perform the calculations. Okay, this is of course not necessarily the case in real life, and later on we'll discuss an alternative metric to use in that case. But at least for the purposes of your studies and the exam, assume that all the information required to do NPV is available to you. And as I indicated a bit earlier, on a big picture basis here, I mean, just look at the equation here, right? Net present value is essentially a cost-benefit calculation. So what we have to sort of look at here is the decision rule here at the end. A positive NPV from a quantitative perspective purely means that the present value of the benefits outweigh the costs. And so that supports going ahead with the project. A negative NPV means that the costs outweigh the present value of the benefits on a quantitative basis, and therefore the project should not be pursued. Let's do a numerical example of this NPV, and what I'm going to do is you can see the BA2 Plus calculator here on the screen, and I'm going to show you the keystrokes for it. Okay, so you've got the case facts. You'll see that the upfront cash flow is 50 million, and we need a minus sign in front of that. So I'll do that, and I will hit enter, and then I will hit the down arrow button. Then it's going to ask me for cash flow 1, and this is going to be a positive number, so I'm going to enter 16, and away we go here, enter, and then the down arrow button. It's going to ask for the frequency. Well, this is going to happen here for the next 4 years, so I'm going to do that, and I'm going to hit enter and the down arrow button. And then the next thing here is the cash flow here of 20 million in year 5. So I'm going to do that. Oops. There we go. Enter, and then the down arrow button. And the frequency of that we want here, of course, is 1. So I'll do that, and I'll do the down arrow button. Cash flow 3 is, that's it. There's no other cash flow, so I'll just enter that as 0. And then I'll hit the down arrow button. And I then want NPV. I'm going to hit NPV here. And then the interest rate, the required return here is 10%. So I'm going to enter that. Oops. Oh, we want 1, 0. Here we go. Enter that. And then the down arrow button. And then we're going to hit compute. And there we get 13.14. Okay, perfect. That's exactly what we want. Now, if we want to show you this here in the computation, just in terms of the actual numbers, you can see the discounting here, and we get, subject to some rounding, 13.136, which is pretty close to 13.14. This next example is unique because it must be done manually because the periods are not evenly spaced, right? You can see that when you look at the at the chart here, there is that odd one here, the 1.5 in there, okay? We could use the calculator only if the periods are evenly spaced, but because of the addition of the negative cash flow at t equals 1.5, the calculator will not work here. Each of the amounts from t equals 1 onwards needs to be discounted by the 10% annual discount rate for the relevant period as illustrated in the calculation. So let's take a look here. Okay, so that should be pretty straightforward to do, although I realize it's a little bit cumbersome to have to do this manually. Now from there, we will see that the NPV is positive at 4.78. The underlying concept behind IRR is straightforward. Now on paper, it is a trial and error calculation, but it can be solved easily on a calculator. We have to compare IRR to the stated hurdle rate that will be given to you in the exam question. And based on that comparison, we have to make a decision whether to invest or not. Now let's take a look at a numerical example involving IRR. This is the same case facts as last time. So if you take a look at the calculator, you can see the cash flows, right? 50, and then the 16, and then the 4 times, and then the 20, and then that happens once. So what I want to do at this point is exactly the same inputs. I'm going to hit IRR, and I'm going to hit compute. And that gives me 19.52. And that's consistent with what we have here. This is showing the actual calculation, which makes it NPV equals 0, and IRR is going to solve for 19.52%, just like we saw on the calculator. So the other thing to keep in mind here is since they told you the hurdle rate is 10%, and because this IRR exceeds the hurdle rate, you should go ahead with the project. Let's look at a problematic case of multiple IRRs due to multiple sign changes. In this case, minus followed by a plus, and followed by another minus. So the existence of multiple IRRs is nonsensical. And as a result, NPV really is the only possible alternative. Because NPV is additive in nature, it can take size into account. In theory, NPV can also deal with an infinite number of sign changes. So both of those features make NPV superior to IRR. Now, as mentioned earlier, when specific project information is not available and only aggregate financial information is available, then we're going to look at the return on invested capital as the appropriate measure. And you can see the formula here. It probably looks a bit more complicated than it should be, but the basic idea here is, what is your net income, your after-tax profits, and your versus your average invested capital. Now we'll go into some calculations on this in a moment, so we'll get plenty of practice here. Okay, but first things first is to become acquainted with the equation. Let's do this example here. We are going to use our net income figure here, the $24,395, and then we're going to use the balance sheet info provided here to do an ROIC calculation. So the numerator will obviously use the net income figure of $24,395 for the current year, but the question is going to be what is included in the denominator for invested capital. Now, of course, remember what we need to do is we need an average amount. So they gave you 2 years worth of information in order for you to do an average. All right, so here we go. We are asking explicitly here for the ROIC amount, and then we have something to compare to, right? It's kind of like a hurdle rate here of 10%. Okay, and let's see if we achieve that or not here. Okay, so first of all, let's go through the mechanics of the calculation. So you can see down here in the denominator, I want you to focus on that, right? Invested capital here, of course, is the long-term debt, right? And it is also the share capital, and it is the retained earnings, okay? And we're averaging the 2 years, of course. It specifically does not include accounts payable nor short-term debt. So that's what you got to take away from this. That's the exclusion. And it is an average, like I said earlier, of 2 years. The asset information is completely irrelevant. So we're going to get a value of 8.73% as the ROIC. Now, compared to the 10% required rate of return, it is too low. And therefore, the investment should not be made purely on a quantitative basis. Okay, great. So I think that's reasonably straightforward calculation. You will sort of learn, I'd say learn by doing. Just practice more of these calculations and you'll be able to do them quicker. All right, now for some qualitative discussion here. The point is to start with some of the benefits of ROIC. So the first 2 points regarding the data and the capital are quite straightforward, right? But the last point, I think, is actually a bit more interesting. So the general rule is that ROIC should exceed the appropriate cost of capital. And since ROIC considers both debt and equity, this is important here, then the appropriate cost of capital that we should be using is WACC, since WACC considers both debt and equity. Okay, that's sort of like the big insight in this section. Now, of course, benefits also come with limitations. So some of the limitations here are actually quite obvious, especially here the first two, right? The fact that it's accounting based, so there could be some manipulation, and also the historical base. So that's pretty clear. Now, if we dig a little bit deeper, we'll see that the aggregated nature of ROIC may not be useful when doing a more in-depth analysis. And then finally, on a more practical note, the notion of invested capital, right? Like the definition is extremely subjective and may omit some very relevant items that would otherwise increase invested capital and therefore result in a lower ROIC. Another way of saying this is that by omitting those items, we could potentially be overstating ROIC because we understated the invested capital amount. Now this slide is just a review of the basic computational aspects in doing NPV and IRR computations that you should already know. So I'll put a star on this because this is very important, and I'll just put a little note that this is review more than anything else. So for example, please do not be tricked into using net income as a measure of cash flow. Right? It's strictly cash flow here for capital allocation purposes. Even more subtle might be the need to ignore sunk costs or any other cost that would not differ between the alternatives. Now, often incorrectly omitted in calculations are opportunity costs and cannibalization effects, since they are usually less direct costs. So if there's anything given to you on that in an exam question, you should always consider it. Let's examine 3 cognitive errors associated with capital allocation. So this would be a must-know here for the exam, and I'm going to just elaborate on each of these 3 points a little bit for you. So the first one with internal forecasting errors. So there's the existence, of course, of very difficult items to estimate. Okay, so we're dealing here with estimation errors, and this will result in wrong costs or rates of return. So an example would be the omission of the effects of competitor responses, for instance, because those are hard to estimate. I mean, you really hard to predict what your competitors will do. So if these errors are large, they could lead to failed or underperforming investments. Secondly, with regards to internal financing, so as indicated before in an earlier module, the major financing source for many companies is cash flow from operations. Okay, and it should be treated as equity financing and assigned a sufficiently high required rate of return since the opportunity cost is a dividend distribution to shareholders. Okay, so in other words, this cost is ignored because you sort of think, well, it's internal, so it doesn't cost us anything. Well, in fact, it does. It's sort of more like an opportunity cost here. Okay, finally, the improper treatment of inflation. So make sure, essentially, it's an issue here of, consistency. Right? And what I'm trying to say is that nominal, which is with inflation, nominal cash flows should be discounted at a nominal discount rate. And real, without inflation, cash flows are discounted at a real rate. Okay, so just remember nominal for nominal, real for real. Okay, so they just have to be the same. So also have to keep in mind here in terms of your computations, inflation rates are not always constant for all the items. The different revenue and expense items may be subject to different rates of inflation. moving along, we also have behavioral biases. So I'd also put a star on this. This is must know, and I will elaborate a bit on each of these as well. So with anchoring, what we're doing here is excessive reliance on the past. You're anchored to amounts that you've used in the past. So ideally, of course, your capital investment levels over time should correlate with return on invested capital over time. The second one here, reliance on accounting measures, as I've indicated before, things like accrual measures, EPS, and net income here are always subject to manipulation here in the short term and may result in allocation choices based on misleading information. So I want to be careful on that. Pet projects involve insufficient due diligence and sort of pushing through projects just because you want them to happen, or having exceedingly optimistic forecasts made for projects that you sort of prefer. Okay. Finally, not considering enough alternatives. Many reasonable alternatives are not raised at the initial idea generation stage. Remember, I said with capital allocation, there's several stages. The initial, the idea generation occurs at the very beginning here. So, insufficient analysis of potential outcomes through break-even, scenario analysis, and simulation. So really not doing enough homework here. So it's kind of similar to the lack of due diligence. All right, so that takes care of some of the qualitative stuff. We're going to move to our final section on real options. Now, real options is, of course, qualitative in nature as well, but we're going to sort of end with a more complex quantitative example. So I want to start off, and again, I'm putting a lot of stars here. This is, again, another must know, the different, qualitatively speaking, different types of real options. So I'm going to just take a moment to elaborate on each of these four. So a timing option here means that investments potentially here could be delayed, or they can be sequenced over time. So what happens is that you may give up short-term returns in exchange for better information in the future. So kind of saying, all right, well, we're not going to do everything at once. We're going to sort of say, all right, the next decision depends on what the outcome of the previous decision was. So you're sort of kind of playing it by ear, so to speak. Now, sizing option here refers to specifically an abandonment option that can be quantified. So you would exercise an abandonment option if the cash flows from abandoning would exceed the cash flows from continuing, right? Growth or expansion options should be exercised to allow for future additional investments if warranted by the future financial results. So essentially a cost-benefit analysis. And I'll show you an example of that later on. Flexibility options include things like price setting options, allow for price increases where demand exceeds capacity. Production flexibility options allow production alterations if demand is not the same as forecast. So that's useful if you over or underestimate demand. It goes both ways. Okay, so just make a note here that the flexibility option here focuses here on demand here. Fundamental options, the entire investment is treated as an option. So the investment may or may not be made subject to events beyond the company's control here. All right. With real options, there are a variety of approaches that could be taken. Okay, so we'll start off here with the three to discuss here. A company could simply choose to ignore the option since the NPV is positive regardless of the option. Right, so let's just say in this situation, the option would just potentially increase the NPV. That's all, but it already is positive. So rather than make it more complex, let's just ignore it. Number two, you could perform a numerical analysis of the NPV with the option, and that is actually what we are going to do. Okay, so there'll be an example on that. Or you can look into other quantitative models, but they require very accurate probabilities and timing of cash flows in order to be effective. So we're looking at decision trees and option pricing models. That's actually an issue that's going to come up in fixed income and derivatives in level 2. But you don't have to worry about that now. You just sort of need to understand the basics of it. Okay, so to finish off, let's take a look at this example. This is a numerical example of NPV with and without real options based on the information provided in this slide. So take a moment to read the case facts. Just note the 500 million outlay and then the details in these 2 bullet points, which are crucial. They've got all sorts of percentages with corresponding amounts. Okay, so then what we're going to do is we're going to calculate the NPV without the real options and with, and then look at the difference so that we can calculate what the value of the option is. Okay, so that's the whole point here. So let's get this discussion going here on this next slide. Okay, we're going to start with the NPV with no option and consider the 60% probability of a 750 million cash inflow in 1 year. All right, and since the inflow is in 1 year, we have to discount it by 10% for 1 period. And that's going to give us an NPV of negative 90.91 million. And so we should not pursue the project. Okay, that's pretty straightforward. Now let's get to the tricky part. Let's get to the NPV with the real option. Okay, now since the case facts tell us to assume a product failure at t equals 1, then we must use the 40% probability in our calculation. And as well, each of the outcomes at t equals 2 has a 30% probability of occurring, so we have to use 30% in our calculations. Okay, so that's illustrated here in this equation. Now, the other thing to consider is that the potential inflow is in 2 years. Okay, so we're going to have to discount this by 10% for 2 periods. That is going to give us the value of the real option of 99.17 million. Okay, so since the value of the real option exceeds the NPV of the project without the option, then we can calculate the project NPV with the real option as 8.26 million, and since it is positive, the project should be pursued if the real option is provided. Okay, so what you need to do is you need to compare this with this. Okay, right, that's your comparison. So one of them has negative 90.91 NPV, the other has positive 8.26 million NPV. So the difference in between is the value of the option. The option is worth 99.17 million because that's how much it raises the NPV by.